So welcome everyone to this fourth webinar of investment solution at iGravity. It's a pleasure to talk about fintech today, and fintech, how to make an impact while generating a profit. That's what we'll try to discuss today. And for that, I have two prominent persons that are joining me on this panel. On the one side, we have Michael Hawkinson. Thank you, Michael, for jumping in to replace Jacob Haar. Michael is the co-founder and partner of Community Investment Management. He's head the business development of the firm today. Prior to that, Michael was co-founder of Minlam Asset Management in 2005. Developed an extensive network, an individual investor for the Minlam Microfinance Fund. He sat on the investment committee, but also performed credit analysis and on-site due diligence on the ground. In 2012, Minlam was acquired by Microvest, which many of you must know. And Michael joined 3Link Global LLC to launch the first SEC-registered impact investment fund. Michael has also published case studies on the profitability of MSME lenders in the famous book, The Fortune at the Bottom of the Pyramid, from Professor C.K. Prahalat. Welcome, Michael, to this webinar. And then on the other side, we have ladies, Elizabeth West, which I'm very happy to have joined our webinar for the first time. Elizabeth is head of impact venture at iGravity. She's based in Washington, D.C. She leads the direct MSME investments and impact-linked loan that iGravity disperse in the developing countries. Currently, we are mainly in Sub-Saharan Africa, and Elizabeth is also a member of the investment committee. Previously, Elizabeth was Impact Finance Officer at Jacobs Foundation. She managed a portfolio of development and execution for around 6 million debt of equity, convertible, and portfolio in social enterprise, especially in the education sector. And Elizabeth has also worked with the Aga Khan Foundation and the Milken Institute prior to that. And last but not least, myself, I'm a partner and head of risk at iGravity. I'm chairing our investment committee, and I've been for more than 25 years in the financial industry, heading risk function, and lately was the CRO of Blue Orchard for the past 6 years. So we have a great panel today, and I'm happy to jumping in. And as usual, we'd like to make a small introduction of the sector. What is impact, and certainly what are the fintechs. And for that, I give the word to Elizabeth to jump in.
Thank you so much, Fred. I just have a few slides that I will present very briefly. And I think my role here really isn't going to be to provide a definition or a scope of fintech, but really kind of note that right now, fintech is a very vague term. And what do we really mean when we say fintech? So really just kind of acknowledging the ambiguity in the term. And for example, is it a sector and it's an umbrella term for a sector? Is it a business model such as the digitization of finance? Or is it a degree of use of technology such as using AI in lending decisions? I think when we say fintech, anytime we're having a conversation, it's really upon us to be as specific as possible about what we're talking about. And I think when we get later into the conversation with Michael, we're really going to be focusing on the transition of financial inclusion to include fintech-based solutions, because I think that's an area of interest for a lot of different parties, especially the parties that are attending this webinar. Next slide, Fred. I think, equally, any estimates of market size are very difficult to validate. There's shifting definitions, there's shifting measurement techniques. So are you looking at valuations? Are you looking at deal activity? Are you looking at revenues generated? And even here, you see a few different definitions that are not quite the same definition of market. So is it the market size? It is actually the technologies themselves. There's a lot of different questions. So instead of really trying to provide an entire overview of what the fintech market looks like, we really just wanted to acknowledge that it's very hard to estimate, but it's certainly growing no matter how you slice it. And this side as well isn't supposed to be perfectly representative of all the different things fintech could potentially represent. As I mentioned, there is a lot going on in the sector overall. The three biggest segments, and again, depending on how you measure, it is digital payments, alternative lending, and personal finance. And then when you get to different regions of the world, some of the other sectors that are growing rapidly or have the largest kind of market share at this point could be capital markets or data analytics in the United States or in Europe, or it could be something else in other parts of the world as well. So just wanted to kind of show the entire sector, what it could possibly mean, even though today, as mentioned, we're going to be talking a little bit more about the financial inclusion side of the fintech space. And now getting down a little bit more into the details, there's, I think a conversation to be had from an investor perspective and an impact investor perspective about what is the additionality of fintech from an impact perspective. So on this slide, you see a few different aspects of impact. And I think that there's some questions we should be asking ourselves, and maybe we'll get into it during this conversation. But for example, where is the additionality coming from in terms of target borrowers? Is it the same target borrowers as financial inclusion and microfinance investment vehicles, but a greater market share? Or are there ways to use fintech solutions to reach even more underserved borrowers that were previously not considered creditworthy through regular credit assessment techniques? I think we can also talk about the measurement system. So I think that the microfinance industry in general has done a great job of developing different impact measures in microfinance. Will those be the same measures under fintech solutions? I think that there's a lot of different subtleties in here that would be great to dig down into deeper. And then, obviously we can't talk about the additionality of fintech from just an impact perspective. We also have to think about it from an investment strategy viewpoint. So just really shifting into the investor's perspective, there's a lot to take into consideration when thinking about investing into a fintech investment. Even on that spectrum of financial inclusion to fintech-based solutions. So one thing to consider is the degree of fintech in the investment model. For example, is the investment opportunity using fintech tools to finance traditional financial inclusion organizations like MFIs or last mile lenders? Or are you investing directly in a fintech platform that's reaching these sorts of beneficiaries directly itself? What is the degree of portfolio customization? Are you financing an entire portfolio, or through a fintech-based solution, are you able to create a custom portfolio where you can really cherry pick certain loans to finance, for example? Other questions go into the leanness of the structure versus traditional financial inclusion in market originations or a fully digitized process, for example, or the use of AI in a particular business model, which I think that there's a lot of different ways AIs are now being incorporated into fintech-based solutions. So really, I just wanted to raise a few different points that I think we can touch upon more in a conversation here now with Fred and Michael, and maybe I'll hand the floor back over to Fred to take us to the next part of the presentation.
Thank you, Elizabeth, for this introduction and the variety of how fintech can be deployed. And looking at you, Michael, now, we know that commodity investment management has been active in the US for more than 10 years, quite successfully. Would be great to start telling us a little bit, the structure and also about the timing of why now going into emerging market, and is that a similar point we're at with emerging market than you were 10 years ago in the US?
Sure, thank you. Great introduction, Elizabeth. Even for insiders who have been very optimistic about the sector, I think in 2020 and 2021 especially has just blown all of our expectations in terms of the valuations of these fintechs and the overall capital that's been flowing. But just to take a step back, the background of myself, the background of Jacob Haar, and our third partner on the emerging market strategy, Bernhard Eichenberg, all is in global microfinance. As Fred mentioned, I'd worked on a book about 20 years ago, actually, which led to Minlam. Minlam was focused on local currency debt for growing MFIs and emerging and frontier markets. And it was at Minlam that we learned about fintech and this is just really during and right after the Great Recession, so 2009, 2010 timeframe. We wanted to do a second strategy for the US market. We were a US-based manager in New York City. And frankly, so much of the US, and I'm sure most of our European friends on the call can appreciate, looks like an emerging market. There is huge income inequality. There is systemic prejudice, racism, and multi-generational poverty. And another piece here is that there's very entrenched predatory lending institutions, whether it's from a product or from a legislative standpoint. So bottom line, there's a huge number of people that need help in America, despite sort of the aggregate wealth of that country. And fintech was a really interesting potential for us because it in our view, it better matched the return and risk potential versus some of the community-based approaches that have been active in America for many decades, like community development banks and so on. So even as we began to explore the US market, we always had a view that based on the venture dynamics within fintech, and even some of the sort of early programs and platforms and so on, which were in places like India, Philippines, Brazil, and so on, we thought, look, fintech is going to be global. It's going to redefine financial inclusion. Why don't we begin with a strategy in a mature credit environment, i.e. the United States, and then let's watch carefully when there's sort of indicators that it's time to work outside the US in some of the same countries where we had already been lending to microfinance institutions. So it was about 3 years ago that we began to basically place this track to launch the Emerging Market Fund, which would happen in June of 2021, basically into the market. And some of those things that sort of paved the way for us were robust venture capital flows, number one, a diverse investable universe of fintechs, number two, and then also that's specific to the CIM approach is some of the regulatory and investment structures and protective legislation that needs to be in place for the CIM model to function properly. So in some sense, it's a huge homecoming, and it's been a really great experience thus far.
Super. Tell us a bit more now, looking at fintech. Elizabeth mentioned clearly, not all are looking for an impact. So how are you filtering for this impact, and how do you ensure the positive impact, and maybe also give some hints about how do you engage with investees?
Sure. Yeah, I think, from an impact perspective, our greatest fear is that the predatory solutions, of which there are many in the digital finance space, come to prominence. And they do that because they are able to get the funding they need. They have the growth that they anticipate, and they become the market norm, and they drown out or strangle out some of the more borrower-centric, impact-centric approaches, products, and services from these fintechs. So deep to our theory of change is that we have to identify the proper solution, the responsible, transparent product that has a view towards essentially helping the borrower, and those have to be financed and brought to an institutional level where they can become the market norms. In the US, for instance, small business lending is completely unregulated with very little exception. So many of the larger scaled early small business loan products are very expensive digital loans. So at CIM, we had to make a clear choice between the rate that a borrower would pay, and we are operating within something called the Small Business Borrowers Bill of Rights, which puts a ceiling on annual interest rates to borrowers. And that is a codified framework that we helped launch about 6 years ago, 2015. It is a codified framework that we have brought to all of our potential fintech partners. We have asked them to sign, basically the CEOs have to, make a public attestation that they will be following these 6 principles, which all relate to different, sort of areas of borrower treatment. And so in absence of healthy law, we are making sort of clear tactical decisions on borrower treatment. We have a lot of experience, of course, with microfinance, where you have very well developed frameworks, the client protection principles and the SMART campaign and so on. In other markets, like US consumer market, you have other types of frameworks that are appropriate, like Compass principles. So in some ways, in absence of the sufficient regulation, which I think is really globally consistent within fintech, as the innovators are well ahead of the regulators, you're looking for best practices, and you're looking for best practices from the perspective of the borrower. How does this product help the borrower to win? Is it fairly priced for the risk of the borrower? Is the underwriter making a decision on repayment ability and not just debt burden, and basically looking for revenue from different types of fees, late fees, prepayment penalties, and so on, which is very lazy underwriting from our standpoint. So it's really looking at borrower health. And second, I would say we're very interested to see the responsible products scale. So we have this scale and demonstration sort of consequence of our capital. And then thirdly, which has been a fair amount of work in the US at least, we have been working on advocacy, policy, and legislation. And we've been involved with 6 bills thus far on small business borrower protection, which first started in California and then went into New York, and now there's a national version of that bill. So there's 3 strata to our theory of change. We can help a fintech think about making their products more borrower centric, and we have clear sort of codified ways to do that, which is probably our most important level of engagement. And of course, with sort of the deep data on these borrowers, we can track borrower health. We can look at things like growth in employment, savings versus alternatives, access to employment opportunities, if this is education, finance, and so on. So there's, with the robust taxonomy within impact, and of course SDGs and so on, these continuing to evolve frameworks, we have more and more specific things depending on the type of borrower, the type of loan product they took, which can measure the health or these, sort of the potential detriment of that product.
You're active in quite a few countries today. Do you think any of these bills have a chance to be also deployed in some of these countries? Is that much too early to talk about it, or?
No, I really do. I really do. I mean, I think what is incredible about these emerging markets is that they are participating in a true leapfrogging with regard to the acceleration of fintech. Fintech is moving much faster than developed markets. So versus Europe and certain parts of Asia, and frankly, progressive politicians and regulators are embracing that, because there's no way to reform the stagnant banking sectors in order to sort of reach all of the bottom of the pyramid borrowers, all of the young borrowers that are characteristic of the demographic profiles of these countries. Fintech is the solution. Fintech will do it one way or another. And ideally, it's going to do it with a responsible and transparent set of products and services. So we've seen
maybe if you could illustrate and give 1 or 2 examples of fintech. Don't have to say a name, but if you want, it's just highlighting the strategy typical to that country that you help financing.
Sure. So there's one thing that has really been front and center when we think about underserved borrowers is refugees and specific crises, humanitarian crises. In Latin America, Venezuela has been in peril for many years, and there's been nearly 7 million Venezuelans. So from a country of 30 million people, nearly 7 million have fled the country and resettled in other parts of the Americas, so all the way from US to Chile and so on. We found our most recent deal, I'm really proud to share, is with a group that started in Chile. The founding team is Venezuelan and Chilean with tech and banking backgrounds. The name of the platform is Migrante, and they are focused on the more than 500,000 Venezuelan immigrants, refugees, that have entered the Chilean market. Many of them are coming from middle income and professional sectors. So with in some cases, nothing except what they could carry. Obviously the transfer of data was impossible, transfer of assets impossible. They designed products that specifically served that population. Loans for diploma equivalent requirements, which would catapult their income earning ability. Loans for vehicle financing, for Uber driving and other forms where the vehicle becomes the asset and can generate income, and small loans for deposits on renting apartments. So really, these are the basics to helping someone rebuild life in a new country. And it's a brilliant sort of fresh look at a person's potential, and completely outside the traditional underwriting from a Chilean bank, which would have no way to work with them. I mean, there's no Chilean credit file on them and so on. So that type of new thinking is, in a sense, it's characteristic of fintech. Fintech we see as another form of innovation in finance, which of course we would include that with, in microfinance is how we would talk about that. And it's reflective of our, sort of volatile, dynamic global community where refugee flows, whether it's in Europe or Central Asia or so on, or even intra-country, in a place like Colombia, they are a reality of the times, and relevant financial products and services have to be able to, sort of design something productive with them.
Yeah, I'm glad you picked up that example. I like it very much. There's one question that also we're facing as impact managers, from our clients, is the one of the impact and return. Is there really a trade-off? And you mentioned the bill which limits the maximum rates. You mentioned paying attention to the way the penalties are applied and so on. So how would you answer that question in terms of the return? Aren't you giving up return for more impact?
I think in some way we have seen predatory fintechs willing to pay higher cost of capital, so willing to pay higher rates for their debt facilities, and we have seen competitor funds allocating at that higher premium. But in our view, if in the long term, if that borrower is not succeeding, then it's not a sustainable business model. So either that client is going to be taken away by a more responsible fintech offering that recognizes the true risk and thus rate for that borrower, or that fintech could be running regulatory risk. So there may be short-term gains, i.e., this quarter, this year, perhaps even several years, where a predatory product can seem to be doing well, and then I think at some point, unless it is designed for the borrower's success, it cannot last, and they would be sort of vulnerable to a number of emerging sort of threats from competition, regulators, and so on.
Thanks. Yeah, that makes a lot of sense to me. Elizabeth, I'm looking at you. I don't know if you had a couple questions on your side as well, or for Michael.
Maybe just one brief one before we open it up. But I think you did a great job of kind of explaining the impact case and the additionality case from that perspective. And how would you say, in general, fintech competes with business as usual in terms of financial inclusion? And where would you say it's most competitive, and where would you say it's least competitive?
I mean, I would say, number one, fintech is very broad. Fintech is serving upper income, middle income, low income. It's serving young, it's serving old, it's serving student, consumer, education, business lending, SME, as well as micro, even large corporate, traded securities, and all facets of financial life. So I see, in some ways, almost unlimited potential for digital finance to transform our financial lives, and perhaps for many of us, certainly for myself, COVID was a great acceleration of the role fintech played, even in my own personal life. You know, I have more virtual payments. I use my Apple phone more than I did before. I never loaded it with the debit card or anything prior to fintech, but it was a quick shift, and frankly, it's been, you know, it's got a lot. It's very convenient and so on. So that I see some benefits. I think where fintech does not do as well, at least in our experience with our nearly 30 lenders and you know 100,000 plus borrowers, is rural. And this is an area that microfinance has made incredible headway with for the last 50 years. So I think part of it is the, you know, sort of connectivity issues, of course, which fintech relies on. It could relate to smartphone penetration, which is going to be higher in urban centers and peri-urban centers versus rural. And it could also be, you know, sort of reflective of the demographic profile in a rural setting versus an urban setting. Younger people come into the city, they're not necessarily going to be the likely client for the microfinance institution. They could be a very likely client for a fintech application. You know, it could help them get a, you know, education finance. It could help them find employment. It could help them, you know, balance their own personal finance, you know, provide other types of lending and so on. So ultimately, I see it as a complement to the sort of high touch, very, very sort of successful model of microfinance. We've seen it as a complement to the high touch model of community development banks in the US, where they are using fintech and they're also using loan officers and other forms of technical assistance, which are essential. These businesses, it's not just money that they need in many cases, it's training. You know, it's the training on how to convert their business to a subscription model, which, you know, could be more compelling to even out income and so on. So that requires more than just, you know, provision of capital. There has to be incubation and training alongside that, and fintechs are not in a great, you know, position to do that. We've seen some platforms basically combine the two together, and that's very interesting. And of course, we've seen many MFIs that have become much more of a digital solution, and that is interesting. So it's you know, there's much more connectivity, I would say, between, you know, these two types of financial inclusion than not.
And then I see a question coming in here, maybe looking as similar to what Elizabeth was asking, but from the return perspective. How have you done any historical studies on how much impact return differ from non-impact ones, and whether you have found a trend in these differentials? So, you know,
so basically,
from
a non-impact fintech fund versus an impact fintech
correct,
fund.
yes.
So we've definitely seen, I think there's some pretty fundamental different approaches from a non-impact credit fund. Number one, they typically take leverage. They are shooting for a much higher net rate of return, but on a risk-adjusted basis, there's much more structural, you know, risk in that type of allocation. So things can go upside down very quickly. So for instance, non-impact fintech funds that were returning 2 to 3% above CIM on a pretty regular basis had catastrophic late Q1 and Q2 2020, and, you know, several of them went out of business, and in part because of the investor base that they had sort of drawn to that type of return. An investor that's typically less sophisticated in understanding from a risk-adjusted basis, what exactly are they buying? And of course, the moment that there is a data point that does not conform with their expectations, they are redeeming, and that can lead to, you know, funds dissolving. And, you know, under COVID, frankly, most of the ones that we were tracking against disappeared. And, you know, we also did lose some investors, and we also had a, you know, much lower than typical return based on a provisioning exercise, but there was no structural leverage in our portfolio. We were able to explain, you know, basically the valuation exercise, and we were able to hold on to the vast majority of our LPs and rebuild our asset base. So again, it's a little bit, is an investor making an investment into a strategy because they believe in the market and they've evaluated manager thoroughly, or as an investor making a trade. And fintech credit right now is a hot trade, but the second that there's some sort of blowback or headwind like COVID, then the trade is over, time to exit, enter, whatever's the next trade. And it's a different investor mentality in a sense.
And if I remember, on the provision side, you recoup the provision or are about to recoup them fully at this stage.
Yeah, that's right. We did. We recouped it over the following 12 months because we had the data of the payments that actually came in, and they came in line with our more optimistic economic recovery scenario. So, again, it's a very exhaustive data-driven approach. It's a relatively conservative approach, but I think we stand by that methodology, and we were able to hold on to most of our investor base. So I think, again, when you're thinking about long-term, it's hard not to think about doing things in an impact-oriented way, because you want to see virtuous cycles. You want to see, the entire community and stakeholder system elevated. So, you cannot do that at the expense of your borrowers. You cannot do that at the expense of promising something that's not realistic when it comes to attracting an investor. So, I think those are lessons mainstream finance can take from impact, which, has, I think very enviable traits in terms of loyal investor bases, consistent returns, non-correlated returns, and of course, being able to provide products, being able to provide capital in times of great need, such as a pandemic, a global pandemic. We know we were one of the only allocators in Q2 of 2020 because, that's exactly what the market told us. We even stood up a separate investment vehicle specifically for businesses not eligible for government stimulus. So these would be undocumented small business owners. And we were only able to do that with the support of our, great investors that said, look, we want to do something above and beyond, what sort of is just the market norm, what's the investment climate. We want to do something to save our community, and this is what they need right now.
Excellent. I was going to ask you a last question, but I think your last sentences were exactly this in explaining what is the final value proposition to our investors, basically, in having this long-term return decorrelation and basically being in it for the good of the borrowers, which is everybody alignments of interest. So I think with that, I'm looking at the time. It's 4 minutes past the half, so I think we'll stick to our timing. Thank you very much, Michael. Thank you, Elizabeth, and thank you everyone for listening to us. And I hope you enjoyed it. And in the name of iGravity, I wish you very, very nice holidays, Christmas, and going into 2022.
Yeah, thank you, Fred. Thank you, Elizabeth.
Thank you,
Thank you, everybody. Happy
Bye-bye.
holidays, everybody. Bye-bye.